is Andrew Swan. I work at Man Group based in Sydney. I run an Asia long-only fund along with my colleagues. I have 5 analysts based in both Hong Kong and Singapore within the team. We've been together really since day one of this strategy. As a team, we're now running close to $5 billion of assets for clients from all around the world. Our goal is, first and foremost, that we're here to deliver performance through the cycle. And I stress that because it is a region of the world which is very volatile, both in terms of just the overall markets, but in particular the leadership in the markets. We've got, a dozen or so countries and sectors, and policy in the region is, given its nature of an emerging market, does change quite regularly, and policy globally affects it. So there is a lot of volatility and changes in leadership. And I feel like my role as a custodian of client money is to try and navigate that volatility for clients through time. The simplest way to describe the process is that there's a combination of both top-down considerations, being effectively macro. The 3 areas that we're considering in that regard are which countries to invest in, which sectors to invest in, what type of investment style is going to work. And the aggregate of all that is the smallest amount of risk and ultimately what's going to drive the returns. The majority of what really drives the returns are the individual securities that we're owning and the diversity of those individual ideas. Because at the end of the day, what we are trying to do is identify a portfolio of companies with the best earnings surprise or chances for earnings to be upgraded versus what consensus is thinking across the whole region. The underlying sort of belief system is that what really drives stocks, both absolute and particularly relative to the index, is changes in earnings expectations versus what the market is anticipating. We call it earnings surprise or earnings revisions. And that forms the basis of our portfolio construction and stock selection. It is a big universe in terms of number of stocks. There's many thousands across more than a dozen odd markets. But the reality is the benchmark that we are trying to deliver those excess returns, which most people, are, as a starting point for investors, is only around about 1,000 securities across the whole region. And about 80% of those by weight of the index is only about 200 companies. So if we can have a pretty good grip on what's happening at around 200 companies across the whole of Asia, we have a pretty good sense on what's happening with the index. And then from there, beyond that top 200, we're really looking for stocks which are really just pure alpha more than beta. So they're not going to drive the index, but they can drive the portfolio. What we are trying to do is just find that edge on every single investment that we're making, where we can find maybe revenues might surprise positively. There are many factors that can come into that. Maybe it's volumes, maybe it's prices, maybe it's competition, or maybe where costs are going to surprise positively, and therefore profits are going to surprise positively. Earnings revisions comes from many sources across the whole region. But the most important thing to know is that it's a constant. There are earnings revisions out there. And so our job is to identify where they are on a forward-looking basis and build a portfolio around that. Yeah, I think, and this is where we've been in the last few years, is the market has been seeing earnings downgrades. Now, in that environment, there's 2 different scenarios. If it's broad-based, earnings downgrades, the whole region's in a downturn, maybe the world is in a downturn, we're really just looking for stocks with the best relative earnings revisions. And when I say relative, we're probably looking for companies that have pretty high visibility on earnings. They're pretty rock solid, or at least close to that. And then the second scenario is where generally the market's overestimating earnings and we can see downside, but within that there's a lot of dispersion and particularly idiosyncratic or very stock specific. And that's really a fantastic time for us because we can the rewards to stock picking in that environment are extremely high when you can find those companies that are really operating independently and delivering based on their own inputs and outputs. It's very hard for us to obviously protect downside in the absolute sense. We do our best in those downturns by owning low beta and being exposed to low beta or underweight high beta stocks. And there's a handful of areas in Asia where you can get some protection to downside. But generally, what we are trying to do is deliver positive relative returns to the benchmark, regardless of whether it's going up or down. And get most of those returns from idiosyncratic risk and returns. So we actively manage the risk versus the benchmark. We target between 65 and 85% of our total risk to be idiosyncratic, so very stock specific. And then that other 25%, let's say on average, of our risk of the portfolio versus the benchmark is managed between style factors, countries and sectors, and really just trying to find within that the best relative earnings revisions again. Look, ESG is incrementally, moving into the region. Not uniformly across the region, but certainly some markets are adopting it in some way, shape, or form. In terms of how we think about it, it has to align to our actual process, and in many ways it does, because there is business risk and earnings risk if companies are, there's consequences, let's say, for bad behaviours in these areas. First of all, on corporate governance, it's absolutely implicit. We obviously do worry about things like fraud and accounting issues. It's always front of our process because, again, earnings revisions need to be really sustainable to work. When it comes to sort of broader issues, particularly around environment and social, what we are seeing is government policy moving in the direction to protect, social issues and environmental issues. And in many cases, it does have fundamental impact on companies. We have seen in recent years, as an example, in China, which does take the environment very serious. They have had an environmental problem. They are looking to reduce capacity in those particularly heavy polluting industries, as an example. And that means that those companies that are leading edge when it comes to environmental practices will probably win market share, and that has a knock-on effect to corporate profitability. So, it is part of our process because policy is moving in that direction. But for us, it needs to align to our fundamental philosophy, and that is around earnings revisions. It's an ongoing issue, and I've seen it throughout my whole career. Sort of investors either love affair or hate for the region. It's either incredibly investable or it's totally uninvestable. Again, it comes down to the volatility I talk about within the region. The reality is the region is full of different countries with different political systems. Some of them are similar to the West and some of them are completely different. What we do know, what we believe, and what has got me through my career is that at the end of the day, what drives equities over the medium to long term is corporate profitability, and particularly changes in corporate profitability versus what the market's thinking. It's very rare that you see sustained periods where prices diverge for non-sort of fundamental reasons. So, if sovereign is a problem, it will probably come into our estimates, in our earnings estimates, in terms of how we think about earnings revisions. And in those situations, if we see bad policy making, we're most likely to be underweight that market versus the benchmark to try and protect returns for clients. So what we're doing with the portfolio is leaning in, I guess, to a better world, I guess is the simplest way of putting it. Can we put more risk to that view? Absolutely. We can continue to lean into that. So the question is, where does that positive sort of view come from? And that really comes down to a couple of sort of big decisions that are, I think, in the process of being made, both within Asia and outside Asia from policymakers. The first one is just, global interest rates seem to be coming down. The dollar is weakening, and that is good for the region. At least historically, that's been supportive for growth in the region. But the second and probably the biggest one is, and we're getting closer and closer to this, is China on the verge of a very significant pivot in what drives its economy? We've been a couple of decades now where it's predominantly been an investment-led economy and supported by higher and higher levels of credit. But we have some very important meetings coming up in China, particularly that will lead to the next 5-year plan, which starts in 2026. And that really governs policy making for that period. And we do believe we're moving into a much more sort of reflationary environment, which would be supportive of corporate profitability, led by a bit more consumption focus in the region and in China. And that should be good for equities. Look, I do think this is a very interesting time to be looking at Asia. The short term is always difficult to know, but the strong currents that are emerging are moving from being pretty big, headwinds to potentially tailwinds. Whether we talk about, a weak US dollar and lower interest rates globally, that historically has been the time to invest in the region. But I think more importantly, the policy, particularly in China, is starting to move to one that's going to be much more favorable towards corporate profitability growth, and with that expansion of valuations, and the combination of that would be strong returns. It's been a while since we've been able to say that. Policy up until this moment has been one that's focused on the quantity of growth rather than the quality of growth, and that's been at the detriment of both corporate profitability and equity returns. But this pivot that's potentially we're in the early stages of, which will last a long time, is one that's going to be much more supportive of corporate profitability and equity returns. If you're coming to the region, we do, I think, have a very strong track record over a long period of time. As I said, I've been doing this for nearly 25 years now, consistently, and so that's first and foremost. Secondly, the process itself does work through time, and trying to understand the intricacies of the region and manage the volatility is not easy for clients, and that's really what we dedicate our time to, with the objective of delivering returns through the cycle. So for us, it's really about, in our mind, execution on a philosophy and a process that we know works. We work very hard to maintain the essential ingredients towards that around teamwork and knowledge sharing and insight. It's, I guess the final point would be that this is all we do. We have a very, in theory, simple philosophy that we're trying to execute on, and there are no other distractions. We're fully empowered to do this, and we have full ownership of the outcome.